Recent events in the Middle East have brought a great deal of uncertainty, not only to U.S. investors and consumers, but to the global community as well. And in times like these, it's natural to feel concerned about potential economic impact. To help provide perspective on this evolving situation, we want to share our view on how the conflict with Iran could affect both the markets and economy. The largest and most direct impact right now is the sharp rise in energy commodity prices and what they may mean for economic growth. Crude oil prices have jumped significantly as a result of the situation with Iran. By our calculations, this hike in oil costs could drive national average gasoline prices higher by about an additional 80 cents to $1.20 per gallon. This increase is primarily driven by disruptions in the Strait of Hormuz, a critical pathway that typically handles about 20% of global oil consumed. Additionally, insurers are currently not willing to provide coverage to ships navigating this narrow corridor, and without insurance, ships are unlikely to make the voyage. This rise in crude oil and gasoline prices could have several negative impacts on the U.S. economy. If crude oil and gasoline prices were to remain at these elevated levels for a full year, we expect gross domestic product, the broadest and most comprehensive measure of economic activity, would decline by about 1.5 to 2%. Economic growth was originally set to benefit from higher tax refunds this year, but those extra funds are now more likely to be partially lost due to the impact of higher gasoline prices. Further, consumers may feel the pinch from higher energy prices and other goods and services, which feed directly into consumer and producer costs. If sustained for a long enough period, higher oil prices could materially pressure consumer spending. Importantly, we do not see the situation as likely to trigger a recession, unless oil prices were to go significantly higher from here. From a business perspective, higher oil prices could have negative implications for corporate profits, particularly for discretionary or consumer-facing businesses. Nevertheless, we believe it's important to remember that corporate profits are starting from a point of strength. Companies listed on the S&P 500 recently saw earnings per share grow by 14% in the final quarter of 2025, a pace we believe is maintainable through 2026. Over the long term, sales and earnings growth have remained remarkably resilient. So what does this mean for markets? In the near term, market volatility could persist as investors consider the durability of the situation and its impact on global prices. However, markets have a long history of looking through unsettling geopolitical headlines over time. And while volatility can feel uncomfortable for a period, it tends to be brief when it reaches extreme levels. More often than not, extreme volatility provides investors a solid long-term entry point to buy stocks rather than sell, in our opinion. For investors, we feel the most effective approach during times like these is to stay the course with your long-term investment strategy. Time and time again, history shows that markets are ultimately resilient and move higher over the long term. If you have questions or concerns about market uncertainty or want to review your portfolio in light of these recent geopolitical developments, please reach out to your Ameriprise financial advisor. Thank you.